Welcome back to this channel. This is Unfiltered Forex with me, Clement, and in this video we'll be talking about the income statement. In the previous series of videos, I talked about the balance sheet and we went over all three parts of the balance sheet: the assets, liabilities, shareholders' equity. So in this video, rather in the next 2 or 3 videos, I will be discussing the income statement. We start with the definition. What is an income statement? Income statements. An income statement or profit and loss account is one of the financial statements of a company and shows the company's revenues and expenses during a particular period. It indicates how revenues are transformed into net income or net profits. The income statement shows how a company made its money within a certain period. So, for example, when you're looking at an annual report, it's going to show you how the company has made money in that year. When you look at a quarterly report, it's going to show you how a company made money in that quarter. From the sales, how many sales they made, how much costs they incurred making those sales, how the expenses and the profit. So even before we go and check an actual income statement, you can hear there are three main parts: sales, stroke revenue, expenses, and a profit. The sales is how many goods the company sold or how much revenue they made. Expenses is the costs they incurred throughout the period and even the cost of selling these goods, and the profit being what's left after deducting the expenses from the revenues as the profit. Okay, now let's look at an actual income statement. Here we are. As you can see, this is the same website, the Apple balance sheet, no, rather the Apple company, and we are this time looking at the income statement. We'll also review income statements of other companies as we go, but I want to use this as a starting point. So you can see the income statement period. This is the annual one. View absolutes, and yeah, you can change how you want to view the numbers, which I'll come to just in a bit. Then order latest on the left. So as you can see, this is the latest annual report for 2023 year ended 2023 September. You can see there are three main parts of the income statement, like I was telling you about. The revenues, there are expenses. Cost of revenues includes part of the expenses. Then there are operating expenses, and then there's the operating income. Earnings for continuing operations, these are also expenses and all earnings mixed. Then the net income. So revenues, expenses, net income. Okay, those are the three main parts. So first, I want to show you how I usually view this and how I think you should view these numbers as you go. Revenues. The revenue, of course, this is the first part you need to check, and you need to see the revenues consistently picking up. These numbers here, they have to be increasing. Okay, of course, if we were able to view the previous year's reports, you would get a much clearer picture of how the company's revenues are going, but this website doesn't offer that feature for free, because of course when you have more data, that's when you can make more accurate decisions. So most websites actually, they usually limit the number of years back you can view. These are only 5 years. Yeah, 2023, 22, 21, 20, 2019. These are only 5 years, and this is the latest quarterly reports. Okay, so now revenues, you need to see first and see that this number is consistently picking up. Then once you have confirmed that this number is consistently picking up, this is the revenues from sales and the products or services the company offers, how much money they made, the total amount of sales made. This is that number, and you want to see it increasing to show that this business, they are selling more and more products each year. Alright, now after you have checked that, what you need to do is change the view now all these numbers as a percentage of the revenue. Okay, as a percentage of the revenue, because this is how now an income statement is viewed accurately. All these numbers, you need to view them as a percentage of the revenue to see which expense is taking up too much of the revenue. That's why this is done. Now let's begin. Cost of revenues. It refers to the total cost of manufacturing and delivering a product or service to customers. It is designed to represent the direct costs associated with the goods and services the company provides. This is Apple, right? You're talking about Apple. They sell products and they also sell services. In the actual income statement of the company, which is available in the annual reports and from the official website or even from the SEC website, the revenues will be split to show which parts is it the products or the services. Revenue from each part is going to be shown when you look at the actual annual report, the actual income statement from the company. You're going to see that there, but this is a summary, so keep that in mind. All right, we will check that, but for now, let's first move on. Total revenues 100%. Okay, now we're viewing these numbers. So the cost of revenues, these guys, they make products and services. So the cost of revenues is coming in where the cost of making an iPhone, the cost of making a MacBook, the cost of making an Apple Watch, the cost of making an iPad, all the products, since they are goods, there is a cost in making them and delivering them to the consumer. That is the cost of revenues. Okay, the total cost of manufacturing and delivering a product or service to consumers. That is the cost of the revenue. What's included here is the production costs, mainly production and delivery costs. That's what's included in the cost of revenues. Okay, so now this number is a percentage of the revenue, meaning for every $100 the company made as sales, $54 of that was the cost of the revenue. Okay, so like let's keep this simple. Let's say this is a phone, this is an iPhone that Apple has made, for example. Okay, this is just a product, or rather the average products that they have sold. So let's say it cost them $54 to make this phone and they sold it for $100. You can see this is the revenue and this is the cost of goods sold. They used $54 to make the phone and deliver it to the shop, and they sold it for $100. As you can see, there is an amount that has been added to this production cost to make it $100, this which is the retail price. So let's go back to the balance sheet, to the income statement. This is the difference now, the profit. Once you subtract the revenue, subtract the cost of revenues from the revenue, you get the gross profit. This is the profit on the product sold. The company has made $46 from selling this phone for $100 after paying $54 for production and delivery. There's a name for this number. This is not the gross profit. When it's a percentage like this, it's called the gross profit margin. Gross margin or profit margin, which is the gross profit divided by the revenue as a percentage. So that's the gross margin or profit margin. Usually this number has to be high, right? High to mean that there is a lot of wiggle room between how much the company is paying to produce and deliver the goods versus how much they're actually making for every $100 in revenue. Okay, so this company Apple, they make $45.96. This is the latest quarterly report. So they make, or rather they made $45.96 for every $100 in sales they made. Now, this is where you need to look at the trend. The cost of revenue, or rather the cost of inputs, it has to be reducing over time. You can see this is 2019. It was 62, 61, 58, 56, 55, 54, meaning this is a very encouraging trend. Every year, Apple is paying less and less in production costs for their products, which is very good. All right. So yeah, that's why you need to look at the trend. This number alone is not enough. You need to look at all other numbers and the trend. In fact, now when you see the trend from a bigger time frame, this is only 5 years. If we were seeing it on a 10-year time window, it could have given us a better picture of how well this company is doing. But even 5 years is good enough. 62, 61, 58, 46, it's reducing, and this is quite encouraging. Of course, the opposite is true for the gross profit. You want to see this number increasing over time. You can see in 2019, Apple used to make around $38 for every $100 in revenue. All right, but this number kept increasing. This was 37, 8, 41, 43, 44, 45, almost 46. Okay, so every year the company has been retaining more and more money from their revenues. All right, this is the gross profit margin or gross margin, and it's supposed to be increasing over time. Operating expenses and income. This is SG&A. It's called SG&A usually. You can see here SG&A. Selling, general, and administrative expenses include all everyday operating expenses of running a business that are not included in the production of goods or delivery of services. Typically, SG&A items include rent, salaries, advertising and marketing expenses, and distribution costs. So this cost of revenues here is how much they spend to make a product, and this is how much they spend in other costs that are not included in when you are making the product. This is, like you can see, rent, salaries, and marketing mostly. This number, you also want it to be decreasing over time. It's supposed to be getting smaller and smaller as the revenues increase. Remember, we already established that the revenues have been increasing over time. So this number needs to be getting smaller and smaller over time. Smaller, why? Because this is an expense. Okay, you are supposed to have a scalable business. Scalable in the sense that even if your business is growing, the expenses shouldn't be growing faster than how your revenue is growing. Okay, shouldn't be growing faster than how your revenue is growing, and they should take up less and less percentage of your revenue. Okay, so in 2019, for example, for every $100 in sales made, Apple spent $7 in SG&A expenses. Then this number, it's increased here, but it's generally reducing, which is good. It's supposed to be reducing. As you can see already, this number is very low, and that's good, meaning managing the company and managing these operations isn't costing the company too much, actually less than 10% of the revenues, which is good. And then research and development expenses, R&D. Yeah, it's called R&D, research and development expenses are direct expenditures relating to a company's efforts to develop, design, and enhance its products, services, technologies, or processes. Even before I continue, there's something you need to understand. In some companies, the cost of revenues here is usually very small, because companies that are more to the side of services, they spend very little money to provide a service to very many people, hence the cost of revenues is usually very small. Let's check Meta, for example, since that's the best example you can use to show a business that is fully service oriented. They don't have any products. As you can see, this is the income statement of Meta platforms, and you know, Meta, social media company, they own Facebook, Instagram, and WhatsApp, and some other small companies, but those are the three main ones they own. As you can see here, the cost of revenues is very small, it's below 20%, because these guys, they aren't involved in selling products. Right? Even Apple, for a business that is dealing with products, this profit margin is actually quite high. This profit margin is quite high for a business that's dealing with products. But for a services business, this is the profit margin, or rather, this is the cost of revenue that's considered normal, and the profit margins are usually very high, meaning for every $100 in revenue, they only spent $18 to get that 100, and the remaining amount was 81. You can see for them here, it's not even too big of an issue if this number stays flat for a while, because it's already very high. And if it continues to increase, because you can see it's increasing, this is 2019 and this is 2023, you can see from 2019 coming forward there has been an upward trend. This trend is quite encouraging, and that's what makes these businesses quite attractive to investors. Coming back to Apple, they also have services in among the revenue sources, and for that one we'll go to check the actual income statement from the annual report to see it's going to be specified where the revenue is coming from. Okay, but before I go there, let's first go over the whole income statement. Operating expenses and income, we've already talked about this, and we were talking about this now. Okay, so research and development, this is of course money they spend to research and develop new products. Okay, so this is going to be very specific for different companies, because different companies have different projects that are very specific to them. Not all companies are working on the same projects. That's why this number is going to be very specific. There's usually no industry benchmark, but this is a very specific case where you need to actually look at what projects is the company doing and which project is taking up the biggest expense, which of course that info is going to be available in the annual report, and we'll go that in a bit. You can see the spending on R&D has been increasing over time, the spending as a percentage of the revenue, meaning in 2019 they were only spending $6 for out of every $100 in revenue to research and develop new products. For Apple, there is the Vision Pro thing that they have been working on. They were also working on the Apple electric car for some time, which that project was discontinued, so the expense there was reduced. But you can still see here that the R&D expense as a percentage of revenue has been increasing, and even the number itself, it has been on an upward trend. Now this mini chart here is showing the absolute values. It's not showing why the percentages. No, this is showing the absolute values. That's why I decided to view this whole statement as a percentage of the revenue, because to check the absolute figures and the trend, you can just see this mini chart here that's popping up. And then there are total operating expenses, which is the sum of these two. If you add 7 plus 6, you get 13. If you add 7 plus 6 again, 14. Now if you the decimals, total operating expenses, these have been picking up for quite some time. Okay? But this is still very low, and it's not supposed to raise any alarms. It might raise an alarm if there's a project here that they are spending too much on whose fruits aren't materializing, right? Yeah, like Meta, for example, you can see their R&D spending was already very high. The R&D expense 19, 21, 20, 28, 27, 25, you can see it has been picking up for some time. And this is one of the things investors really worry about. But you can see from the selling, general, and admin expenses, this number as a percentage of the revenue, even if the number itself has been increasing, which is logical because as the business grows, you will incur more expenses to run the business. So this is okay when the absolute number is increasing, but when the value as a percentage of the revenue is increasing, that's a red flag. So, but for them here, you can see this value is reducing over time. So this is good. This company means every year they are making more money than they are spending on expenses. Okay, yeah. But the R&D expense here has been picking up for some time, and this did raise concerns for among investors. So you can even view now, you can change and view the percentage of YY growth on R&D expenses to see how by which degree they have been increasing. So this again, this is a red flag and it makes investors worry about the future of the company because they might be spending too much on research and development. There are specific projects that take up a lot of money and are specific to every company. That's why you need to see the actual annual report once you have already established this. Okay. For example, Meta, they even rebrand to Meta because of the metaverse. So they have a Meta lab, the metaverse lab, which has been taking up most of the R&D expense, the R&D budget. Okay, that's what's happening here. If you check the actual annual report, you're going to see it there. But for now, let's move on. So you can see for them, their operating expenses are actually half of the gross profits. 42, 80, 41, 80, 50, 79. This was actually bigger. I mean bigger than half. 43, 80, 40, 81. The total operating expenses for the company usually is half of the gross profit. But if it's bigger, it's a problem because it reduces the operating income. The operating income is the sum total of a company's profits after subtracting its regular recurring costs and expenses. So this 41 is after you have deducted the total operating expenses from the gross profit. Okay, because 81 minus 40 is going to give you 41, right? So this number, this operating income, and this is the operating income margin when it's like this as a percentage of the revenue. This is still a margin, and this margin has to be growing bigger over time. Again, when you check this mini chart, this is going to be the absolute value, but this is the margin. So in 2019, after cost of revenues and operating expenses, this company Meta was only making $41 out of every $100 earned in revenue. In 2020, this number reduced. In 2021, this number increased a bit. This is 38, this is 39. In 2022, there was a problem here, right? There was a big problem here in 2022 because operating expenses were quite high as a ratio of the revenues, because you can't be making $100 and $20 of the $100 is going to cost of production or delivery of services, and then whole $50 is going towards research and SG&A operating expenses. So this was a problem. Okay, yeah. And then investors really complained during this period, and that's why the company changed in the following year. You can see the SG&A expense was toned down a bit, and even the R&D expense was reduced a bit. Note this margin. This one should be increasing over time. Like we can see for Apple here, this margin has been increasing over time, which is quite encouraging, right? Moving on. Still now this is expense and other earnings. They are combined here now because there are earnings that a company makes that don't come as a result from sales, and earnings that will come as a result of sales. Like if the company made an investment in another company and that investment started bearing fruit, that income is going to come under this part, right? And you can see interest and investment income is here, meaning for every $100 in revenue, 97 cents was from investment income. Okay, you can see this number has been slowing down for some time, but no worry. Interest expense, this is what you need to be careful of when you are looking at this part of the income statement, because it tells you how much of a company's revenues are going to pay interest on loans. All right, interest expense is the total amount a business accumulates in interest on its loans. It's the cost of borrowing funds, in short. So yeah, this is the cost of borrowing for the company. Remember when we were looking at the balance sheet, we saw there were assets and liabilities, and among the liabilities, the biggest ones is usually debts and loans. Okay, so this now is the interest on those loans. How much of their revenue were they giving up for interest on loans? So this is good. But if this number is high, right, it's going to be a problem. Meaning, because if it's high, like 10 or 20%, is going to mean that most a significant portion of the company's revenue will be going to paying interest on the debts, and that's not going to be very good, right? So yeah, interest expense, this is it. Then again, we've already talked about interest and investment income. Again, interest and investment income is money derived from interest payments, dividends, or capital gains realized on the sale of stock or other assets. Remember when we were talking about the balance sheet, and there were, let me check my notes so I don't confuse, and there was a part for other receivables. This which was other sources of revenue for a company, like if a company gave out loans to employees or maybe even to other businesses, once those loans start being paid back, that's money that the company receives is an income and is going to be recorded here, interest and investment income. Okay, yeah. And then net interest expenses represent interest payable on any borrowings, bonds, loans, convertible debts, or lines of credit. It's calculated as the interest rate times the outstanding principal amount of the debt. Another one, other non-operating income or expenses. You can see this number has been like that. And then earnings before tax. Now this is the taxable income of the company. For every, now this number means for every $100 the company earned as revenue, they only retained 25% of that to be taxed, right? Yeah, so and then the tax here was 4% of the total revenue, meaning for every $100 the company gained, 4% or $4 was going to taxes. So after you have deducted operating income and after you have deducted cost of revenue, you get 37. After you deducted operating expenses, you get 24. Now you just have to take the operating income, deduct the interest expense, and then again come here and deduct the income tax expense. Then now you're left with the net income of the company. This is now revenue minus all the deduction. Deduct cost of revenue, deduct operating expenses, deduct interest on loans, deduct the tax, and then deduct, after deducting the tax, you get the net income. Okay, so the net income, now this is, again, this is the margin. When it's displayed as a percentage of the revenue, this is a margin, and the same way you checked the revenue and saw it was increasing, you also need to check the net income to see that it's increasing over time. There was a slight decline here, but it was still quite high. So again, the net income, it has to be increasing, and even before now you draw a conclusion, you also need to check the net income margin. This is the profit margin on the net income. This number also has to be increasing. If this number is increasing but the net income, the absolute value is reducing, it might present a confusing scenario whereby the company's net income is falling but they are actually making more per dollar for every sale, for $100 of every sale. They're actually making more. So in that case, you will now, I don't want to say if it's going to be a good or bad company because there are other features at play, but that's not a bad scenario. As long as this number is increasing, it's usually good. There are companies whose net income is usually very low, but that's not a problem because again this varies across different industries. If you check Meta here, for example, you can see their net income is usually above 30%. And this year was a very bad year, very bad because of the operating expenses, right? Yeah. So the net income is usually over 30%, and that's what a business like this is supposed to be showing because this is a business that majors in service or product, just services. Back to here, there are supplemental items. Now these supplemental items, they are very, I can't say very important, but they are quite a lot, as you can see, and they are highly monitored by market analysts when trying now to analyze the actual profitability of a company. Now this is revenue per share. As you can see, the revenue per share is the amount of revenue per outstanding share of the company's stock. You want to see this number pick up, right? If as long as this number is picking up, it's good. And as you can see from this part of supplemental items, the numbers here now are in dollars. They are not in dollars except for the share amounts, but not as percentages because this percentage part is only spreading to the net income. Okay, from the revenues to the net income. These are the only numbers that are displayed as a percentage of the revenue. But when it comes to these supplemental items part, it's going to show you in the dollar numbers, right? So revenue per share. That means for every one share, there was a revenue of $14, and this means for every one share, there was a revenue of $24. This number you want to see it pick up, meaning the company is making more revenue per share. Companies try to increase this number by reducing the number of outstanding shares of the company's stock. Remember when I was discussing the balance sheet, talked about share buybacks that some companies do, like Apple has been doing for quite a while now, and that's buyback, that's reducing of the number of standing shares of the companies is actually what helps such metrics boost. Okay, because we're talking about earnings per share. If you have more earnings and fewer shares, the EPS is going to pick up quite fast. You can see this was $2 and now we're talking about $6. So yeah, the EPS is picking up quite fast. Basic EPS, continuing EPS. I will have to now do a video talking about these ratios, but what you need to understand is the income statement is very important, especially when it comes to looking at operating expenses and the cost of revenues. These margins, they are very important. This is gross profit margin, this is the operating income margin, and the net income margin. Now this is how per dollar amount that the company makes. I was supposed to go now to the actual annual report of the company. So let's go there. Remember, if you want to get any company's financials, you have to go to their investor relations website. Just type company name plus IR. You can see here Apple Investor Relations. This is the one we're checking for now. Okay, so once you're here, you can go to SEC filings. What you're looking at, or rather what you're looking for, is the 10K, the annual report. Remember, the annual report is called the Form 10K. You're going to click here, go to annual filings, and here it is, 10K annual report 2023. And then you can select the format you want. Let's view the PDF file. You can download this, by the way, and read it for yourself offline. I'll download this one and then I'll view it from my PDF reader, which is the one I prefer. Here we are. This is now the same annual report. And remember, if you want to scroll to the financials part, it's usually under item 8, index to consolidated financial statement. And then now you want to check statement of income, or rather statement of operations. It's again what it's called. So for example, here you can see it has been divided into products and services. Okay, that's very important to monitor because some companies that have both products and services, the services part is really important to see how well a business is growing their services. Usually, just like you have seen, companies that venture into services products, they have higher margins, higher profit margins, right? And that's what's very important when you're trying to analyze the profitability of a company. And then again, I don't know if it's in the same annual report where you're going to find the actual products sold. Let me try and search. Yeah, I have searched iPhone since I know this company sells iPhones, and what I'm going to try and do here is find the parts of the revenues where it has been specified where the revenues were coming from. Let's go here. Yeah, it's here. Products and services performance. You can see net sales by category: iPhone, Mac, iPad, wearables, and home accessories. And then there are services. Okay, so this means Apple made $200 billion in iPhone sales in the year 2023. Yeah, you can see $8 billions. So there was a reduction of 2% yearly change from 22 to 23, but from 21 to 22 there was an increase of 7%. That's it. If um, allow me to show you another company, now a service company. Okay, you can see here all the services have been listed as services, because this is usually mostly a products based kind of company. So most of their revenue is coming from the product side. You want to check Meta? Yeah, Meta IR investors. Yeah, you can see here this website has split them better because it's been split quarterly earnings, and you can go to annual reports of annual filings 10K. So yeah, this is the one we want. Let's check the PDF from 10K. Go to item 8, financial statements and supplementary data, consolidated statements of income. This is now where we want to be. And you can see revenue, costs and expenses, cost of revenue, development, marketing, sales. And now if you want to view where the revenue was actually coming from. Oh, by the way, in the, what do you call it? In the income statement, some companies do record the change in foreign currency, like the effects of the foreign exchange rates, because sometimes, especially these big multinationals, the difference in currency valuation or devaluation could mean hundreds of millions of dollars either in profits or in losses for them. Okay, so that's why it's usually listed as a separate item, because to see how much of their revenues was coming from, or how much of their revenues got lost in between currency transaction or currency conversion. Yeah, some companies do that. Now I'm going to search one obvious service that I know Meta has, and I know that's where we're going. In fact, let me just search revenue recognition, and there is advertising revenue. This is what I wanted to see. I don't know if I think it's a bug. I should go up. This part, note 16. This is the notes section of the financial statements, and this is where you can find revenue has been split further. Revenue family of apps. This family of apps has been described here. Family of apps includes Facebook, Instagram, and Messenger, WhatsApp, and other services. Yeah. Family Reality Labs. This is Reality Lab. Reality Labs includes our augmented, mixed, and virtual reality related consumer hardware, software, and content. As you remember, I told you, yeah, Meta, they're heavy on this metaverse project of theirs, and they're finally starting to realize some profits from it. Okay, and then, yeah, it has been listed here. Revenue. Family of apps revenue was $133 billion. Reality Labs, the revenue was $1 billion. And income, now this is income from these operations. The family of apps generated an income of $62 billion, but the Reality Labs was actually a loss of $16 billion. And you can see that's why this company is the Meta is usually under fire from investors about these reality labs of theirs. They're not making any money on these things because you can see here the spending was bigger than the revenue they got from their reality labs. So you can see why investors really like looking at the annual reports because it goes into detail on which part or which side of the business is actually failing, which side of the business is actually doing good. And that's why investors really like to monitor this. Okay, let me go back here. And this is Netflix. Okay, you can see Netflix, they are in the show business, and they make movies, and now this is the cost of making those movies. It's included here, right? If you go to another company like Tesla, for example, the Tesla's gross margin has been reducing in the recent past. That's why Tesla, even the stock itself, hasn't been doing so well, and they have come under fire for these this margin compressions. Why it's a big deal? It's coming as a result of whenever the product pricing of the company is failing, like let's say Tesla is doing price cuts on their cars. Those price cuts they do on those vehicles will be reflected here, meaning now they're making less money per product sold, and that's a problem. And when you go to the now net income, it's slightly higher because of some interest here and some other incomes that come in from operations. All right. Yeah. And yeah, if you check back in 2019, you can see the company was actually quite struggling these margins, and that's why it was a problem for them. Earnings from continuing operations, the net income was actually a net loss. Some companies do have a net loss, and remember the net loss where it's financed from either through sale of assets or in new money funding from either the government or from private investors. That's how some companies manage to stay afloat despite having a net loss, no income. I think now I am done with this video. I will release a separate video talking about these supplemental items, EPS, basic EPS, diluted EPS, because these are very important and I'll have to talk about them separately. Didn't want to make this video too long. Anyway, that's it for this video. I hope you liked it and I'll wait for the next one.